The Federal Reserve just said the quiet part out loud, and almost no one noticed. In the January 2026 FOMC press conference, Chair Powell was asked directly about the path of disinflation. His exact words, "Further progress in bringing inflation back to 2% is not assured. Recent data have shown that inflation has become more persistent in certain sectors than we had anticipated." That single sentence is the invisible trigger. It's not just a cautious remark. It's the quiet admission that the old playbook is broken. And buried inside it is the seed of an inflation surge that will hit full force in 2026. Most people heard it and moved on. But if you understand what it actually means, you just got a 12-month head start. The Federal Reserve has a dual mandate: maximum employment and 2% inflation. For decades, that mandate gave them independence and credibility. They could raise rates, cool the economy, and bring prices down, even if it was painful. But something changed after 2008 and accelerated after 2020. Massive fiscal deficits became permanent. Modern monetary thinking entered mainstream policy circles. And quietly, almost without anyone noticing, fiscal dominance replaced central bank independence. Today, the Treasury's borrowing needs shape Fed decisions more than the dual mandate does. The Fed is no longer fully in control. The government spends, the Treasury issues debt, and the Fed must accommodate or risk a fiscal crisis. That is the shadow authority now driving policy. Look at the pattern. Post-2008, QE was sold as temporary emergency medicine. It lasted almost a decade. 2021, trillions in fiscal stimulus, supply chains broken, energy prices spiking, and the Fed called it transitory. They kept rates at zero for another year. 2022 to 2024, repeated promises of a soft landing, higher for longer, turned into rapid cuts once labor data softened. Each time, structural drivers, deficits, deglobalization, energy transition were downplayed. Each time, the narrative bought time until it couldn't. The through line is clear. The Fed has consistently framed temporary problems as temporary, long after evidence showed they were structural. So why is inflation now stuck? 3 drivers, plain and simple. First, fiscal deficits running 6 to 8% of GDP in peacetime, with no political will to cut them. Second, deglobalization and the energy transition pushing up commodity and shipping costs for years to come. Third, services inflation fed by a tight labor market and wage demands that companies can still pass through to prices. These aren't cyclical shocks, they're structural shifts. And as long as all 3 remain in place, inflation doesn't glide gently back to 2%. It stays elevated and eventually re-accelerates. That's the system the Fed just admitted they can't fully control. And that's why 2026 is going to look very different from what most people expect. The turning point isn't coming, it's already here. In the January 2026 dot plot, the median longer-run federal funds rate was revised up again, now sitting at 3.0%, the third upward adjustment in 2 years. At the same time, the CBO's latest baseline projects deficits averaging 7.2% of GDP through 2035, with interest costs alone hitting 3.8% of GDP by 2030. This combination is lethal. The Fed has effectively abandoned the old forward guidance that promised a swift return to 2% inflation and sub-3% neutral rates. They are now signaling acceptance of a higher neutral rate environment while fiscal policy remains on autopilot expansion. That is the rule change. When monetary policy stops fighting fiscal dominance and starts accommodating it, the inflation baseline shifts permanently higher. The Fed now faces a no-win scenario. Option 1. Resume tightening to force inflation lower. But with debt to GDP at 130% and interest payments already the fastest-growing budget line, aggressive hikes would spike debt service costs, force emergency spending cuts or tax hikes, and risk a full-blown fiscal crisis. Option 2. Pause or cut rates to support growth and labor markets. But with services inflation still running above 4% and fiscal deficits pouring fuel on demand, any easing would quickly re-accelerate price pressures and unanchor expectations. Either path leads to the same destination: higher long-term inflation and higher nominal yields. The only difference is the speed of arrival. Here's how the cascade unfolds, step by step. Persistent services inflation refuses to fall below 4%, driven by shelter and wage-sensitive categories. The Fed delays rate cuts longer than markets expect, keeping policy restrictive into late 2026. Labor markets stay resilient. Unemployment remains below 4.5%. Participation stalls. Workers demand and receive wage increases of 4 to 5% to keep up with living costs. Companies with pricing power, most of them in concentrated industries, pass those costs through rather than accept margin compression. Inflation expectations de-anchor. 5-year break-evens rise from 2.3% toward 3%. Treasury yields back up across the curve, with 10-year pushing toward 5%. Higher yields balloon debt interest payments, forcing even larger deficits to avoid austerity. The Treasury issues more debt. The Fed eventually slows or pauses balance sheet runoff to stabilize markets. More debt plus more money creation equals higher inflation. The loop feeds itself. The Fed's traditional tools are now politically and structurally constrained. Quantitative tightening was supposed to run off $95 billion per month. In practice, it's already being tapered quietly because draining reserves too fast risks another 2019-style repo crisis, especially with global dollar funding needs still elevated post-debasement era. Other major central banks face identical binds: ECB with Southern European debt, BOJ with JGB holdings over 100% of GDP. No one can tighten aggressively without exporting deflationary pain to neighbors. The result? Global liquidity remains abundant even as policy rates stay high. The system has lost the ability to truly tighten financial conditions when fiscal policy is this expansionary. In this regime, nominal returns on paper assets become meaningless. A 10-year treasury yielding 4.5% sounds decent, until inflation averages 4 to 5% and real yields stay near zero or negative. Long-duration bonds lock in purchasing power erosion for decades. Cash and T-bills offer temporary relief, rolling at positive real rates for now. But once the inflation reacceleration hits, even short-term rates lag behind price increases. The divide is simple. Nominal wealth can grow on statements, while real-world buying power shrinks year after year. Most portfolios are still built for the old regime, where bonds eventually hedged equity risk and delivered positive real returns. That world is gone. Every sustained inflation regime creates clear winners and losers. Winners? Owners of real assets, commodities, energy infrastructure, farmland, industrial real estate. Companies with inflation pass-through, resource producers, utilities, certain consumer staples. Equities in sectors with pricing power and low debt loads. Losers: anyone reliant on fixed income streams, retirees drawing down bond-heavy portfolios, pension funds locked into long-duration liabilities, wage earners in non-unionized sectors without bargaining power, holders of long-term nominal contracts like annuities or fixed-rate debt receivables. The transfer is slow, then sudden. It's already underway. Watch what sophisticated players do, not what they say. Corporate share buybacks hit another all-time high in 2025. Companies borrowing at 5 to 6% to repurchase stock because executives know cash on balance sheets loses value. Private equity dry powder sits at record levels, but deployment is heavily tilted toward hard assets: energy, infrastructure, agriculture. Billionaire family offices have been net buyers of farmland and commodities for 5 straight years. Meanwhile, retail investors remain overweight long-duration bonds and mega-cap tech, assets that performed best in the disinflationary era. The smart money is rotating. The crowd is still positioned for the world we left behind. The legacy investment mantras no longer apply. 60-40 is dead. Bonds no longer diversify equity risk when both fall together under higher inflation and yields. TINA is dead. There is no alternative to stocks when real assets offer better protection. Just wait for the pivot is dead. Pivots now come with inflation baggage attached. We have entered the fiscal dominance era. The old rules were built for a world of independent central banks and declining debt ratios. Those conditions are not coming back. Anyone still following 1990s to 2010s playbooks is going to get carried out. Let's bring this home. By mid-2026, the inflation surge isn't going to feel like abstract CPI numbers. It's going to show up in your daily life. Grocery bills will be 20 to 30% higher than they were in 2024. Not because of one-off shocks, but because food producers, distributors, and retailers will have passed through years of accumulated costs in energy, labor, and transport. Rent and home prices will keep climbing faster than wages for most people. Shelter costs, already the stickiest part of inflation, will eat an even larger share of household budgets. Mortgage payments for anyone refinancing will jump. 5 to 6% rates become the new normal, not the peak. College tuition and out-of-pocket healthcare costs will once again outpace wage growth by several percentage points a year. Retirement account withdrawals will buy noticeably less each year. A portfolio that felt comfortable in 2024 will feel tight by 2027, forcing tougher choices between lifestyle and drawdown rates. This isn't hyperinflation. It's the slow grind of 4 to 6% annual price increases that compounds into a permanent reduction in living standards for anyone without direct inflation protection. The worst part, it becomes self-reinforcing. Higher inflation pushes nominal interest rates up. Higher rates balloon the government's interest expense, already on track to exceed defense spending by 2028. Larger interest payments force even bigger deficits, because neither party will accept the austerity required to offset them. More deficits mean more Treasury issuance. To absorb that issuance without market tantrums, the Fed eventually accommodates, slowing runoff, pausing hikes, or restarting asset purchases in all but name. More accommodation feeds back into higher inflation. Round and round, this is the fiscal doom loop. We saw mild versions in the 1970s, but this time we're entering it with debt-to-GDP ratios twice as high and no demographic dividend to grow our way out. History doesn't repeat, but it rhymes, and the echoes are getting louder. A 1940s post-war surge, massive deficits financed by financial repression, inflation peaking above 20% before yields were capped. The 1970s stagflation, oil shocks layered on top of Great Society spending and loose money, requiring double-digit rates to break the spiral. Japan's lost decades, the inverse, deflation trapped by high debt and demographics. But the loss of monetary control is the common thread. This time combines the worst of all three: 1940s debt levels, 1970s supply shocks from deglobalization and energy transition, and Japan's demographic headwinds, all without the young workforce or credible institutional trust we once had. Every prior episode eventually resolved, but only after years of pain. This one starts from a weaker position. We have crossed a regime boundary. The era of the all-powerful independent central bank delivering lowflation and ever-rising asset prices is over. We are now in the age of fiscal dominance, where government borrowing needs override monetary restraint, where inflation volatility is permanently higher, and where real assets matter more than financial engineering. The old mental model, buy the dip, wait for the Fed put, trust bonds to hedge stocks, has expired. A new model is required, one that treats inflation not as a bug to be quickly patched, but as a persistent feature of the system. Most investors, advisors, and institutions are still operating under the expired rules. That gap is where the damage and the opportunity will be largest. Here's the dividing line. The majority will remain in denial until the surge is undeniable, until grocery bills, rent checks, and portfolio statements force the reality check in 2026 and beyond. They'll react late, chase performance, and lock in losses. But you're hearing this now. You're part of the minority that sees the structural shift early. That awareness alone puts you months, maybe years ahead. You don't have to ride the full wealth transfer. You don't have to watch your purchasing power evaporate while others profit. You can still position yourself on the right side of the regime change, while the best opportunities are still mispriced. You don't have to sit there defenseless. There is a way to protect yourself and even come out ahead in this new regime. The framework I use breaks down into 3 core pillars. Pillar 1, direct exposure to real assets that rise with inflation. Things like commodities, energy, precious metals, and certain types of real estate. These aren't speculative bets. They're stores of value that have preserved purchasing power across every major inflation episode in history. Pillar 2, ownership of cash flows that are explicitly linked to inflation. Businesses with strong pricing power, revenue streams tied to commodity prices, or contracts that adjust upward with CPI. These generate income that grows as prices rise, rather than income that gets quietly eroded. Pillar 3, geographic and structural diversification. Spreading exposure across jurisdictions with different policy mixes and asset classes that don't all correlate with the U.S. fiscal situation. This reduces the risk of being fully captive to one government's borrowing spiral. Take one concrete example playing out right now: copper. The energy transition and data center build-out are driving structural demand that supply cannot match for the next decade. Prices have already started a new upleg, and producers with low-cost assets are generating margins that scale directly with the metal price. That's the kind of inflation-linked cash flow that belongs in a protection portfolio. But here's the critical part. The timing, the weighting, and the specific vehicles matter enormously. Get the allocation wrong, and you can still lose. Chase the hot theme too late, and you buy at the peak. Most people, even sophisticated ones, get this wrong because they're still thinking in the old disinflation framework. If this resonates, if you're ready to stop operating under the old rules and start preparing for what's actually coming, do 2 simple things. Hit the like button. It tells the algorithm to push this message to more people who need to hear it before 2026 arrives. And subscribe with notifications on. I'll be breaking down more of this regime shift, the assets I'm watching, and the moves I'm making in the weeks ahead. The window is still open, but it's closing. Like, subscribe, get positioned.